Tuesday, September 27th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Keith Weiner. He's the CEO and founder of Monetary Metals. Keith, I should have probably had you on a long time ago. I've been following your writings even before I think you had your company, when you wrote for, I think it was called the Gold Standard University, which was a university founded by Professor Anto Fekete, the late Professor Fekete. So yes, welcome, and how are you?
Thanks for having me, and that was quite a long time ago.
Yeah, I think it was back in, I think 2007. I think one of my colleagues at work said, "Oh, you have to read this guy and Professor Fekete."
It couldn't have been, so 2007, I was still running a software company called Diamondware, which I sold to Nortel Network in 2008, August 19th. So minutes before the crash. I didn't know at the time.
Maybe I started following Professor Fekete before you.
Right.
Yeah. And so maybe you could tell us how you got involved in gold and silver.
So I sold this company August 19, 2008, which was a very surreal experience for a lot of reasons. For any entrepreneur to go through that, it's like, 14 years building a company, and then you suddenly give it away and you get all this, what I thought of as money at the time, the US dollar not being money, but that's what most people think it is, including myself at that time. And then watching, in the days and weeks after that, the implosion of Nortel, the implosion of the world, and starting to become a bit alarmed, like what is going on here? And then, you see what they say on TV and you read what they say in the Wall Street Journal, Investors Business Daily, and you're like, none of this makes any sense. At best, these people are starting in the middle and kind of chasing their tail. And so I was just reading everything I could obsessively at that time. And I read all the books by everybody that's, famous in this space, including, Harry Dent and Bob Prechter and everybody else. As well, peripheral to the, gold community, and eventually came across the writings of Fekete on one of the sites. I don't remember if it was Safe Haven or 24 Hour Gold, one of those sites. And I remember thinking, I don't know if he's right, but he's asking what I think are the right questions. I don't know if his answers are right, but he's asking the right questions at least. And he's attempting to get to the root and start at the beginning, which impressed me. So because of the way the acquisition was done, I had almost unlimited vacation time coming to me. So when I saw that he was running another course in Hungary, I said, okay, I'm going to get on the plane and go there. No particular intention to, become a serious student of economics, just was part of my phase of figuring out how do I protect myself. And over the ensuing months and years, came to think that there's a very grave defect in our monetary system, which is much more obvious now, but I think it was starting to be obvious after 2008, and that gold had something to do with the solution, although I wasn't necessarily that clear as to what that might look like. Certainly going back to fall of 08 and first quarter of 09. So I started attending his courses, and then I started writing essays, just to help myself learn, right? There's no way to learn something better than actually writing about it and sharing my essays with the professor, of course. And then I got to a point and I wrote one, and he said, I think you have enough here for a dissertation. I encourage you to, I was like, whoa, I'd never thought that my life would go in that direction. So my background, I studied computer science and dropped out. So my whole life I was just resigned to think, okay, I'm a college dropout, a pretty successful one, I think, but I'm just somebody who got what I needed to get out of school, wanted to build a software company, got that itch, left undergraduate school probably about a year shy of actually getting a degree. Never thought I'd go back for anything, let alone a soft, thing like economics. I was, physics and math and computer science all the way. And, but anyway, did that and, really gelled my ideas on what's wrong with the monetary system and how to how to try to fix it. Just obsessed with this idea of Archimedes, who supposedly said, you can move the world, I can move the world if you give me a long enough lever and let me put the fulcrum at the right spot. And I thought, okay, well, how do you do this? And is anybody else trying to do this? And so the idea for monetary metals sort of came about in my mind as I was, as I was studying.
I see. And when did you found Monetary Metals? And maybe you can tell the viewers what you do exactly. And I just wanted to specify to the viewers that I'm not affiliated with Monetary Metals. I'm doing this because I think Keith is very interesting, and we're going to talk about more later on about gold as well and silver.
So I founded the company in 2012. And at that time, the idea was around that people should keep their books in gold. So when you say, okay, my net worth is whatever, $100,000, $1 million, everybody should get in the discipline of divide that by the gold price as of that moment. And then if your net worth is going up in dollar terms, but going down in gold terms, you're working hard and having all the headaches, taking all the risks, but you're actually losing real wealth. And then I thought, what if you applied that to a company? What if you applied that to a fund? So we created a fund that ended up being a niche product that traded the gold silver ratio, which we have since closed. And 2016 launched what is now the core idea, the flagship product of the company, which is a fixed income on gold. People should be able to get a return on their gold. This is the Warren Buffett objection. So I assume most of your readers will be familiar with Buffett and his various expectorations about gold over the decades. He doesn't like gold. He's made that clear. He puts it down, but it's always in kind of a disingenuous. What he says is true and disingenuous. Well, you buy a lump of gold and you put it in your desk drawer, which nobody would put a lump of gold in their desk drawer, but 20 years later, you pull it out, it's still the same lump of metal, being neither procreative nor productive. How absurd this is. You pay all these guys to dig the gold out of the ground, and then you pay more guys to put it back underground and guard it. Gold has no utility. And, it's true, but it's also disingenuous because we live in a very anomalous time that the government has banished it from the monetary system. And so it's turned it into either a hedge or insurance or speculation or something like that. But it's not financing anything. So he's right about that. But of course, he's saying that in defense of the failing dollar system, which has been very good to him in his career. But so what we at Monetary Metals is doing is answering that Warren Buffett objection and saying it is productive and procreative. Of course, it was for millennia until Roosevelt came along in 1933 and made it illegal. Gold was always used to finance productive things. Gold has a ton of utility if the government doesn't squash it. And let's try to return that utility, and let's try to. So independent of all this, I got involved in trying to advocate for better gold laws, both here in the state of Arizona. Every year for 5 years, I showed up to testify before both House and Senate subcommittees, writing letters to the governor. He never granted me an audience. Lobbying, meeting with other folks, meeting with legislators offline to really give them a deeper explanation. And I got involved in other states, Texas in particular, a little bit in Utah, Wyoming. And after 5 years, the gold legal tender bill in Arizona was diluted every year. It got vetoed 3 times by 2 different Republican governors, even though it passed on strict party lines here. What finally got passed was so watered down compared to what originally had been. I walked away from that experience thinking, wow, this is far too much effort for far too little change. If the world is going to change towards being a gold standard, isn't going to be by lobbying these guys. It's going to be a bottom-up entrepreneurial, ding, look at Uber. They didn't lobby the government for better taxi laws. They just said, well, let's make something better available. Let the customer decide. And that was the idea for what we're doing today. So if gold has an interest rate, then people will deposit their gold because people naturally seek profit. And if you can make profit by depositing your gold, people do that. And so we had to go set out and prove that that was true, which it has been. The growth in deposits has been exponential. And on the other side of the business, we have to prove that there are businesses that want to finance in gold denominated capital rather than dollar denominated capital. So these are jewelers and refiners and mints and high-tech manufacturers. There's a bunch of verticals where they need gold as either inventory or work in progress. So the old conventional way that they would finance themselves is they would borrow dollars and then buy the gold inventory. But now you have a mismatch. You have $1 million debt, you have $1 million worth of gold. What if the gold price drops 10%? Now you have a $900,000 asset, but you still owe $1 million, you're bankrupt. So then they have to put on hedge, which ends up with more costs, obviously, and complexity and moving parts and risks. And if you lease the gold from monetary metals, then you don't have any of those issues anymore. It just becomes simpler, more user-friendly. So we spent, I would say, 3 to 4 years proving that there was a customer on both sides of the trade. And by arguably 2019 or 2020, proved that, and it's been, scaling the business ever since. And I would argue, as an economist, I think there's a more formal definition of gold standard, but I think a good informal working gold standard would be one in which anybody who wants to can choose to deposit their gold and earn interest on their gold in gold. If that condition prevails, you have a working gold standard. So that is what we are trying to create, is that condition.
I see. And I guess you could also deposit your gold and say, we don't want to lend it. Do you provide that as well? And also maybe what is the current rate for interest rate that you're getting, let's say, for if you lend gold for a year with to another counterparty through monetary metals?
Yeah, so if you just want to store your gold, yeah, you could do that with us. I'm not sure why. I mean, that's not the value proposition we focus on, not what we advertise. There are a lot of companies that are advertising all the things they do for safety and security and picking the right offshore jurisdiction and all those things. So we're probably not best equipped to deliver on that value proposition. Interest rates. So we have two different programs. One is the low. You can never say zero risk. Anybody who says it's risk-free and getting a return, you should run fast and far, because that person is either a fool or a liar or both. But the lowest risk thing that we can think of is leasing gold to companies that have that gold as inventory or work in progress. So the gold is physically there. We lease 1,000 ounces to a jeweler. Let's say they're manufacturing jewelry. So every day they're buying, let's say, a kilo bar of 4/9 gold. And then they squash it under rollers and they bend it and weld it and polish it and set stones in it and whatever. So every day they buy a kilo. Every day they sell a kilo of finished necklaces and earrings and whatever. But there's always, let's say, 30 kilos, 1,000 ounces, more or less in the pipeline. So we'd lease them that 1,000 ounces. That 1,000 ounces is always physically present. We go to great lengths to monitor that and control that. We can show up on premises, scrape the gold, put it on a scale. It weighs greater than, prove that it weighs greater than the lease amount. It's insured. They have to carry insurance. We have an additional layer of insurance at our level. This is the safest thing that we can think of to mitigate and eliminate, as many of the risks that gold could go away. And the interest rate on that is between 2% and 3%, depending on the deal, net to the investor. So there's obviously, we make money. We obviously charge a fee, but we charge that fee to the lessee, not to the investor.
And is that, does investor gets paid in gold? Yes.
Gold. And there's no storage fee. So the actual swing, if the investor is paying 0.5% for storage, conventionally, and now they're doing it through us at 2.5%, let's say, then the net gain to the investor is 3% compared to where they are right now in gold. So if you give us 100 ounces, at the end of the year, we give you back 102.5 ounces.
Yeah, and is it open to investors from everywhere around the world, or is it just a US US
No,
based?
we have quite a client base that's outside the US as well as inside the US.
Great, great. That sounds quite very interesting. Maybe we could now move on to other topics, like the way you look at the price of gold, because even I and most people, when they think of the price of gold, they think of, well, the gold is at $1,700. But you have an interesting way of looking at it. Maybe you could talk a little bit about that to the viewers.
Yeah, so in light of what I said earlier, that gold is really the proper measure of economic value, and the dollar. I mean, I think everybody realizes dollar is well, the dollar's falling by design, right? So if you go to the Federal Reserve's website and they talk about their price stability mandate, it's actually something out of Orwell, because price stability is defined as relentless 2% inflation forever. And so Orwell's got to be looking down on this and just shaking his head saying, guys, this wasn't supposed to be a recipe book for how to do it. But the dollar is also unstable. You know, a point I made in the gold versus Bitcoin debate that I had at Soho Forum is that the designers of the dollars would like to think that they can make the dollar go down in a smooth, uniform math. We would call that monotonic. You know, not just only going down, not having big ups, just going straight, straight line down, which of course is wonderful fun for anybody who wants to lever up. So you borrow dollars and you buy assets. That's the name of the game. And if you know how to play that game, you can get very, 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 very rich, which is a wealth transfer, which is a whole different discussion. But the problem is it's unstable, and every once in a while there's huge drawdowns in the middle of that curve. Even in the 1970s, price of gold goes from $35 to 800, and there was like a 50% drawdown. I don't know if it was 1976 or 1977, and I think there was a couple of 35% drawdowns. So you get this wicked volatility every once in a while, which is the dollar being unstable, not gold being unstable. So what we encourage everybody to do, again, is calculate your net worth in dollars, calculate things in dollars, calculate the dollar. I'm sorry, in gold, not in dollars. Calculate the dollar in gold, and say what is the dollar worth in gold rather than what is gold worth in dollars. And when you do that, a couple of interesting things come into sharper focus. And I like to use the example of before Copernicus, the medievals obviously thought that everything went around the Earth. It created some complexity that was really hard to even calculate, let alone there's no explanation of it. And that is, if you look at all the other planets, especially the inner planets, you get this so-called retrograde motion where it's apparently going like this, and then it goes back for a bit, and then more and back and more and back. And how do you explain that? There's no physical analogy of like a rock on a string or anything like that. And once you realize that everything's going around the sun, then your model becomes a hell of a lot simpler. And so, it's kind of Occam's razor. Sometimes the simpler explanation, is the more compelling one. There are certain anomalies that if everything is priced in dollars, if dollar is the measure, and gold is just one of the things that's going up and down, revolving around the dollar, then there's some really weird anomalies. One of which, and I've heard several very prominent speakers who are great thinkers, at conferences say, at the end of the day, gold will go no offer. Well, that's a curious thing. If you study markets, it's always the bid that goes away in a time of crisis. Imagine if the US Geological Survey said there's going to be a major earthquake in Los Angeles, 17 on the Richter scale, nothing taller than a dollhouse will be left standing. What would happen? Well, there would be no bid on real estate, probably from Santiago, Chile to British Columbia and Canada and as far east as the Mississippi River, there'd be no bid. Plenty of offers, right? A lot of people would be saying they want to sell their house in LA or their skyscraper in LA at whatever prices that people would be making up. Some would try to bargain, well, 10% discount. Other people would be unloading a 50% discount, but there'd be no bid until the earthquake happened. And once the dust settled, then there'd be a new bid in the market, possibly a lot lower. But gold, supposedly the one exception, goes no offer. How do this is just one of those weird anomalies.
So you probably mean there will be no bid for the dollar.
That's right. But if you look at it the other way and say it's the gold that's the money and the dollar is some sort of credit instrument, then it's the dollar that goes no bid. Well, what's the bid on the dollar ultimately? Well, it's gold. Gold was drawing its bid on the dollar, and therefore the universe now makes sense in the same way that when you switch from geocentric to heliocentric, then all this funky math goes away and things become much simpler and much easier to explain. Oh yeah, that's right. That other planet is just like us. It's going around the sun, and all the weird special cases go away. And so I think, yeah, people should use gold to measure everything, including the dollar. And then, which also gives you a certain peace of mind. You realize, okay, the dollar's been going up the last couple of months. It's not the same stress. Okay, there's an asset that's going up and I don't own it, or don't own as much of it. I'm not all in on that asset. Isn't nearly as bad as I bought this asset and it's going down. Now, the Bitcoiners try to adopt this, the same rhetoric, but they kind of have to concede that Bitcoin doesn't have anywhere near the stability to claim credibly that, oh yeah, the whole world is revolving around Bitcoin. Big things are measured in Bitcoin. I mean, that's obviously ludicrous.
Yes, and before we go on to what's happening right now in the markets and gold and also interest rates with the bond market, maybe you could talk a little bit about the gold basis and backwardation. I remember Professor Fekete used to always say that the day the dollar would collapse would be when there would be constant backwardation, both in gold and silver. And one of the problems I have with the backwardation looking at COMEX is that COMEX doesn't really seem to be a physical market, at least for the general public. Maybe you could cover that a little bit.
Yeah, so the paper that I wrote, that when he said you should apply for your dissertation, I argued, I took the permanent backwardation thesis a bit further and said that permanent backwardation in gold would actually drive a corresponding proportional backwardation in all other commodities, starting with crude oil. And so you'd see everything going into backwardation. You'd see the gold price rising exponentially. And as it rises, the backwardation would be deepening. And that would be your sign that, we probably have a few days to weeks left before the whole thing collapses. So let me take a step back. And here's how I explain backwardation. So start with a commodity like wheat. And there's some key differences between gold versus wheat. But and I don't know the exact mechanics or the timing of the wheat market, but I think in the US, the harvest is generally in late July to August. So suppose you went to one of those grain elevator towns in mid-July, like a few days before the wheat harvest was set to come in. And imagine all the silos would be empty. They pop the tops off of them. You could see daylight in them. They're hosing them out. Everybody's getting ready for this massive inventory that's about to come in, and nobody has any wheat. Suppose you drive in with one of those grain trucks and you say, how much to fill this grain truck here with wheat? Well, they'd laugh at you. Nobody has any. They say, go buy it on the futures market, kid. And if you're willing to stand for September delivery, it'd be whatever, $5, $6 a bushel. See, no, I'm serious. And you take out a wad of $100 bills. Well, somebody in that town is going to get on the phone and make a phone call to some trucker who's halfway to Milwaukee, delivering to a beer company or something, or a bakery, and saying, turn that truck around. We're going to make more money by selling it to this idiot, and we're going to have to pay the bakery to get out of the contract, but we'll make money. So he turns around and says, okay, for $20 a bushel, you can have the wheat right now. So that's backwardation at a very tangible level. If you have to have it right now, it's $20 in this example. If you're willing to wait, a month and a few days, it's $5. So now imagine you're seeing these prices on the screen. You're not actually physically standing there in the mud in the grain elevator town, and you see that spot is 20 and next month is 5. that should be a signal that there's a real scarcity, there's a real shortage. Because in financial markets, if you see two prices on the screen, you can put on an arbitrage to close that, well, you profit from it, but in so doing, you're selling this one that's higher, you're selling the $20 one, which is pushing it down, you're buying the $5 one, and those should be arbitraged until that gap is largely closed within a few pennies anyways. And the fact that nobody's doing it, and day after day after day, you see that backwardation that's growing, indicates nobody can do it. So the key with that trade is you actually have to have wheat. It's not about going to a bank and getting credit. Anybody has credit. Nobody has wheat until the harvest, and then that backwardation would flip. So gold is very different because virtually all the gold ever mined, and so far as we know, at least 5,000 years of human history, all that gold is still in somebody's hands. And even the gold is lost in a shipwreck. There's always, and always has been, people that try to go to, especially in the harbor where it's not that deep, try to recover the gold. People that are buried with gold teeth, well, there are grave robbers that come and exhume the corpses to take the gold. Gold's largely recycled. So there's never any such thing as an actual scarcity of gold, but there can be a shortage of gold to the market, depending on market conditions. So the first time this occurred was when Gordon Brown, who at the time was Chancellor of the Exchequer in the UK, decided to sell and loudly announce and make a big flashy showing of it. I'm going to sell it. I'm going to sell it, you bastards. I'm going to dump this on you. And so naturally push the price of gold down to multi-decade, lows, dumped all that gold. And there was a day in October, now I want to say it was 2000, but I almost feel like I could be off plus or minus a year in the height of that he drove gold into backwardation for one day. That it had so oversold that there was actually a shortage in the market. And when he was done with the selling, obviously the price moved up and never looked back. And what an idiot he was for that. The next time that there was any backwardation, and we have the data going back to 1996, so I can say this having actually looked at the data, was in the fall of 2008. And what was happening in the fall of 2008? Well, people were getting to the point where they didn't trust the banking system anymore. You didn't know what was going to happen to your counterparty next. You had Bear Stearns that went under, you had Lehman that went under. There were incredible rumors about Merrill Lynch, if they hadn't been acquired by B of A, that they would have gone under countrywide. So in gold, the trade would be, if you see a backwardation, you can profit from it. You sell your gold bar for cash, you put that cash in your futures account, and you buy. So in December of 2008, you'd buy February of 2009 contract, and you can make something like 2.5% annualized. It's hell of a rate for a risk-free trade, or at least the conventional system defines this as risk-free, because there's no margin calls. You have the full cash to pay for your contract. Nothing can happen in the meantime, except for one thing, which is if the banking system declares, well, they wouldn't declare bankruptcy, but force majeure, and that would obviously force the COMEX to declare force majeure. Then what you've done is you've taken your gold bar. This isn't a gold bar, it's a little gold forum, but you've traded your gold bar away, and you've gotten this piece of paper in return. And with a promise, this piece of paper promises to deliver gold in 60 to 90 days. If everybody declares force majeure, you're left holding this, you don't get your gold back. So it was not a risk-free trade. And in December of 08, that calculus was being performed. You don't know how many people were looking at it, but what we know is that all the gold mined in 5,000 years of human history is somewhere, and all of those owners globally decided not to take 2.5% risk-free trade, which is a very, very serious thing. Fekete wrote about it at the time. This was a little bit early for me to be writing about it. I was just beginning my journey into all this. And what's happened since then, so that backwardation was cured, and the cure was higher prices. So higher prices pulls more gold into the market. Crisis averted temporarily, or staved off is maybe a better word for it. And then we've had, so I coined the term temporary backwardation. We've had temporary backwardations intermittently ever since. we never had before, before 2008, except for that one day during the height or the depths of the Gordon Brown incident. We never had backwardation before that, and then it became a irregularly recurring pattern ever since. And so it's a signal of scarcity to the market, which in the case of gold, since there is no such thing as scarcity of gold to the market is a very grave signal that there's something wrong, that trust is breaking down, and that trust is the cornerstone of our civilization. If that should break down, then everything else breaks down.
Yes, and do you see that starting now? How is the backwardation in gold and silver? And maybe you could also talk a little bit about, I don't know if you follow, there's apparently, well, there is a premium between Shanghai gold and London gold, about 2%, maybe a little more. Is that a sign of fragility in the system as well?
I don't see it that way. In my view, gold can move from one corner of the market to another. And, there's a general belief in the gold community that it is always and constantly moving from west to east. That isn't true. Their market can flip the other way as well. And my understanding is, so not only are there capital controls making it hard to get, cash and gold out of China, but there's also quotas on bringing it in, because when you import gold, you're giving up hard currency. China right now is desperately trying to defend their currency, which wants to go down. And so I think this is simply a product of they're not allowing enough imports of gold to cure the price discrepancy. So there's an arbitrage gap there of 2% or whatever it is. And the cure for that would be buy London, sell Shanghai, but you can't, because the Chinese government has interposed a barrier, at least for the time being. So gold, I do not see anything remotely approaching a backwardation. I see a 3%, the opposite of backwardation is contango. And there's a 3% carry rate right now in gold. So that is buy spot, sell forward, and you can make about 3%, which, it could be a little bit lame, relative to T-bills right now. So, in terms of the scarcity of the gold market, so the gold lease rate has been rising for some time, and the gold lease rate is basically at a record, multi-year record here at this point, which means that, yeah, there's some tightness. Silver was where the real story was. So silver actually had a backwardation briefly, as there was a lot of retail buying, and that persisted against all paper assets being sold. And so you had this backwardation in silver, but that backwardation has subsided. So the retail buying ran out of momentum, and you can see it clearly in the data. So what the lease rate does is it takes into account that the interest rate has been relentlessly rising. If the interest rate's stable, the basis gives you a nice signal. If the interest rate's moving, then the lease rate is interest rate minus the forward rate, or basically the basis.
Keith, maybe to wrap up, you could give us your view of what you think is happening in the currency system, the monetary system, with the central banks, the bond markets, and what you think the end game is. Are you one of those who thinks that we're going to see a shift from paper assets to hard assets in the coming decade or so?
I certainly think that more people have a clearer picture that they need to own, something real. And of course, the center of that universe would be gold. I mean, you can own a 1955 Ferrari, but what's the bid on that 1950 Ferrari? You can own a Picasso, but so those are hard assets, but ones that are subject to the bid dropping away in times of stress. And gold would be the thing that never happens. I think more people are clear that, yeah, you got to own some gold. The monetary system's gone mad. And at the same time, I think there's a lot of forced liquidations of gold, because people are trying to meet margin calls. And not probably right now, gold hasn't dropped enough or fast enough to really trigger margin calls on a gold position necessarily, but people are facing margin calls all over their portfolio, and they find the one thing, and this is the role that gold plays par excellence. You know, its bid doesn't tend to drop, so you don't end up with huge losses trying to sell your gold. Whereas if you had to try to sell real estate right now to meet a margin call somewhere else in your portfolio, you know, you would take a real haircut on that. So gold is being sold, but at the same time, I think buying is also very vigorous, because there's another group of people that are like, wow, you got, and then the other currencies, crazy stuff happening. The pound, I saw a graph that looked like a spike low of $1.03 in the pound before it recovered to $1.06. I'm not quite sure how. Sometimes those spikes are kind of spurious, created by the data provider rather than by the actual market price. But even $1.06, that's lower than where the euro was until fairly recently. So that currency volatility is killing certain traders. They're surely going bankrupt over this right now. We just haven't seen too many stories, you know, about that yet. And everybody who's living in Britain, in Europe, in Australia, in every country whose currency is going down, is taking huge losses. And, you know, in America, you know, everyone's complaining about inflation of this or that percent. Imagine your currency going from $1.50 to $1.06. You know what that does. And in the rest of the world, they're very conscious of the dollar being the center of the currency world. So I think I'm somewhat controversial to say all the other currencies are dollar derivatives. And so as credit is contracting, as Powell is deliberately tightening credit conditions, then that pulls from the periphery in, and the periphery is the euro and the yen. And I mean, look at the yen, that not collapsed. The pound, but also the yuan is under downward pressure. That credit contraction is pulling from the peripheral currencies into the dollar, and the dollar is, from the perspective of the rest of the world, going up and skyrocketing, which is enormously destructive. I mean, if you're a US tourist, that's great. Go visit the UK, and you know, the pound is now $1.06 rather than $1.56. Great, have a vacation. But you know, everybody on the other side of that trade, which is every citizen living in the UK who kept his savings in this currency, just suddenly got a wake-up lesson, wake-up call on what it is to hold your savings in a irredeemable paper currency. Are they all thinking about gold? Hell yeah. And as they should. Now, is this the end of the wave? Is there going to be a correction? The pound goes back up to $1.20. I have no real opinion on that. Technically, it sure looks like it's oversold and the move get reversed. But clearly, the trend is other currencies down against the dollar. And the interest rate thing is a very interesting thing. I like to talk about, and I don't know if this is true in the rest of the world, the car commercials here in the US. The car makers are still, as much as Powell has hiked interest rates, offering 0% financing on a car for 72 months, 6 years at 0% interest. How much does that subsidy cost the manufacturer? Well, whatever it costs them, it's costing them a hell of a lot more than it did a year ago. It was costing them a lot even then, which tells you that, number one, the demand, at least for auto credit, but I think this is a bellwether for demand for all credit, the demand for credit is weak, except on a downtick in interest rates. As the interest rate has gone up, the demand for credit collapses. And so I don't think this is durable. I think that this is going to reverse and hard. And we are, you know, the yield curve has been inverted for some time now. So Powell can push up the overnight interest rate. He can't push up the 10-year interest rate. And so you have this, you know, inversion. What was I going to say? That looking at the car loans tells you that manufacturers are calculating the losses that they're taking on the subsidy, which I'm sure are substantial. But that loss is less than the loss that they would be taking if they had to charge the market rate of interest. If the car commercial said, buy this brand new Jeep Wagoneer, and not 0% for 72 months, but 6.5% for 72 months, the loss in sales volume would cause even greater losses to the company than the losses they're taking on the subsidy. It tells you the magnitude of the problem. that must be occurring everywhere. Obviously, in home mortgages, what's the demand to borrow money at a home mortgage right now? What is it, 6 or 6.5%? And everywhere you look, and the same thing for business loans, the demand for credit at these rates has vanished. I think that will reverse itself with a vengeance. And then it's a matter of, political calculus as to how, Powell's can react and when, which crisis. I mean, there's so many incipient crises that are brewing out of this. It's almost kind of a roll the dice, like from Dungeons and Dragons, one of those 20-sided dice. Which crisis is the one that blows up in Powell's face? Or you picture he's in this ivory tower and he's on the 100th floor. Which crisis becomes big enough that all the little people on the ground, he doesn't really notice the pain. But when the fire gets up to the 100th story window, that he actually notices it and kind of looks up from his book and comes to and says, oh shit, there's a crisis. Which crisis will that be? Will it be bank insolvencies? Will it be, markets crashing and assets crashing? Will it be GDP, 3 quarters in a row of contracting, or whatever they can't deny as recession indicator? Which, will it be all of the, the G7 countries flying to Washington, begging an audience with Powell, getting on their knees and praying, please, Chairman Powell, would you, Your Highness, Your Majesty, would you please give us some relief because this is killing us? Which crisis will it be? Who the hell knows, but he's brewing a lot of them. And then is there a deeper political game? Is Biden doing this to turn the screws on Europe right now, or Russia, or some other play that he is trying to play or imagines he's playing? I don't know those things, but.
So I guess when there is, when Powell finally reacts to a crisis, that's when the dollar will start dropping against gold, would you say?
I mean, the dollar could be dropping against gold even long before then, but if it hadn't been by that point, absolutely it would. So picture 2009, what happened to the price of gold?
Yeah. And what do you feel, how do you feel about manipulation? Do you think there is manipulation? And if so, does it really impact on the dollar price?
So I'll say a couple of things about that. And I've been a very controversial person for my views. And I've made some enemies for saying what I say, but ultimately you have to follow where the truth leads you, and people hate you for it, so be it. Number one, I've met plenty of politicians, both at the state level and at the national level, and internationally. I travel a lot internationally. I know members of parliament in a lot of places. Number two, I've met a lot of central bankers, both again domestically and internationally, and had in some cases some opportunity to have candid, off the record conversations. These people don't think about gold. They really don't. If you bring up gold to one of these people, it would be like if you met the chief engineer at Tesla and you start talking about, are they going to incorporate carburetors in a Tesla? I mean, the person would almost kind of pause for a minute, and it's kind of like, wait, what? Like they think gold is gone 100 years ago, and for good reason. They don't think about it. It's not important to them. It's not on the top 100 things they think about. It isn't even in that list. That's the first thing I would say. And if you read what their remarks and everything else, the last Fed guy that thought about gold was Greenspan, and the way he thought about gold while he was Fed chairman was quite different from the way he thought about it when he was writing for Ayn Rand in the 1960s. Before that was Paul Volcker. Volcker did his PhD dissertation on the gold bills market, but of course he came of age, back during a time when there was still a gold standard. Everybody since then came of age, long after that, and regards it as an antiquity, kind of like horses and buggies or outhouses or anything else you think of as the 19th century. So I've written a lot about, manipulation from a data perspective, because monetary metals, and by the way, we publish all this stuff for free. You come to monetary-metals.com, we have all these charts. There's 60 some odd different charts of looking at the kind of micro internal structure of the gold and silver markets. So all this stuff is available for free, but we've put together what I think is the best data set anywhere in the world. We've licensed what's called the tick history database that gives us to better than sub-millisecond resolution every bid and every offer on every gold and futures, gold and silver futures contract and spot going back to 1996. So we have the data to back some of this, and we've written a lot of articles when there's been crashes and people said there was a paper smash. We can show the kind of forensic breakdown at high resolution and say this is what happened in this way. So I think the definitive article that we put out was called Thoughtful Disagreement with Ted Butler. So Ted Butler wrote, I don't know if he still writes after that, but he basically said, hey, look, I've done my life's work. I've shown a spotlight on this. I've done all these things. I've made my contribution, and kind of like a professor emeritus, I'm just retiring now in my golden years, and put these ideas out there. But if anyone has a thoughtful disagreement, I welcome it. So I said, okay, in the spirit of that, let me write this letter. And it was called Thoughtful Disagreement with Ted Butler. And I started out by saying, let me try to, the opposite of a straw man is a steel man. Let me try to summarize your argument in a way that you would agree with, that I've not misstated or mischaracterized your argument in some way. And now let me posit a scientific experiment. So when you have two competing theories, so let's say Einstein predicts in his theory, Einstein has one theory, Lorentz, let's say another guy has a different theory. Scientists look for some weird corner case where the two theories would predict opposite behaviors to occur in a circumstance. So there's some super duper magnetic pulsing quasar thingy, and Einstein says light is going to bend to the left, and Lorentz says light is going to bend to the right. So all the physics is now sitting on the edge of their seat, waiting with bated breath, and for somebody to build a telescope powerful enough to go look deep into the universe and find one of these objects, and then they can see which way light bends, and then bends to the left. Einstein is vindicated. Lorentz is tossed into the ash heap of history. So what is the corner case? There's two theories here. One, we'll call it the conspiracy or manipulation theory, that the banks are naked short to manipulate the price. The other is the arbitrage theory. I hold the banks are arbitraging. If they can buy spot at $1 and sell forward at $1.01, they can make a penny, which is 1%. But since they're only doing that for a one month trade, that's more like 8% return. So you have two competing theories. Let's find the corner case where they predict opposite behavior. And now we have the data. We have the telescope that gets the data, which is all this analysis we've done of the markets. And let's see how every futures contract going back to 1996, 126 some odd contract, let's see how they behave in this corner case. So that's the setup for the article. That article is called Thoughtful Disagreement with Ted Butler on our website. I encourage everybody who's interested in this to read that article. It makes an argument that it makes. I will note one thing. That article was published on every site that you could possibly be interested in if you were interested in gold. It was Zero Hedge, it was on GATA, it was on La Metropole, it was on 24-hour gold, it was everywhere. I have to think that Ted Butler must have had 50 emails when he woke up that morning. Did you see what Weiner said? Did you see what Weiner said? GATA themselves turned me into a one-word celebrity, and they wrote a headline, "What Weiner doesn't want to know," or something like that, which I just, I've spent hundreds of thousands of dollars building this platform. It's kind of a little bit odd to accuse me of not wanting to know something. But be that as it may, that article was everywhere. I have not received to this day, and that article would have been 4 or 5 years ago now. I've not received to this day a thoughtful response to that. I've had a lot of people accuse me of a lot of things. I've had some F-bombs dropped. But it makes essentially a scientific argument. It's saying, here's a theory, here's another theory, here's what this theory predicts, here's what this other theory predicts, which is opposite. Here's the data. The data shows that this theory is confirmed and this theory is rejected. It's pretty dry.
So basically you're saying the bullion banks are just selling futures or paper or the gold and buying, arbitraging back and forth, and they do thousands of lots, so that because they have access to cheap credit, and they have access to the bullion from the LBMA, right?
Well, it's just a carry. If you buy futures contracts, I'll sell it to you. Now, retail investors assume that the contract is a zero-sum game. You go long the contract, someone else is short, and the short guy is going to lose when the price goes up. But nobody really wants to be for the long term on the short side of the gold trade. That's retarded. Obviously, the price of gold is a long-term rising trend.
Yeah, that's right.
Yeah, for an illegal trade, there's a lot of people that would short gold, but certainly not take perpetual position. So what the banks are doing is arbitrage. They simultaneously buy spot and sell forward to carry it. And the basis is the measure of the profit they can make for that carry. And we publish that basis every day. And that basis is generally profitable. So if you have access to credit at anywhere near the LIBOR rate, you borrow at LIBOR, you buy that bar of gold, you sell it forward, you pocket a little bit. Nobody gets rich on carry trade, but if you can put it on volume, you can make a living doing that. And that's what these guys do. And so much has been said about it that this isn't really quite accurate. And, these guys from time to time do things that are generally regarded, without getting into whether spoofing should or shouldn't be illegal. I'm really a free markets guy, but leaving that aside, there was a JP Morgan guy a couple of weeks ago, criminally convicted in a court in Chicago for manipulation. Now, it wasn't long-term price suppression. This was not a case that the gold price should be $50,000 and is somehow held down to a mere $1,700 by some long-term, cartel in cahoots with the Fed. This was the guy who was spoofing, who was putting in orders that he didn't intend to fill, and to scalp pennies off of whoever was the trading counterparty in the market at that time. And in that case, it's very clear he did it in both directions. So sometimes he pushed the price up a few pennies, sometimes he pushed it down a few pennies, and he was scalping those pennies for his own, for his bank's trading account. He got criminally convicted. Then the boss now, I think, is on trial. There was a guy a few years ago, was it Deutsche Bank, who again, criminally convicted of that same thing. Yeah. So every once in a while, these guys are doing something that is not regarded as good or healthy or ethical anyways.
Yeah, I agree with you. The spoofing is more of a short-term thing. What I would say about the futures market, because I don't know if you've seen, there's a WikiLeaks document from 1974, before the COMEX gold was created on December 31st, just in time for January 1st, 1975, that the US Treasury and the government wanted people to be more involved in the futures market so that they wouldn't, buy physical gold, to take physical out of the market. So I think that's what the manipulation is all about, is to keep people just trading paper. Yes, a lot of times it does look like the banks come in and manipulate the price of the futures, but like you said, they could be doing something else on the other side.
Yeah, I mean, the bank is long gold in some form or another, not necessarily in a COMEX warehouse. Again, keeping in mind virtually all the gold mined in 5,000 years of human history is still out there. The banks are long gold in one form or another, which could be a gold loan to a gold mining company, and then they're short the future, and they're just pocketing that little spread. Back to 1974, I think they thought a lot of things that weren't really true. And it's kind of interesting to me that if you look at everything else those people were saying, everybody in the gold community would be laughing at them and saying, people are incredible, they're mendacious, they're fools, or this or that. They picked this one thing that somebody from 1974 said, and it'll have to be true because it was said in 1974. I think those people didn't know what they were doing. If you look at who buys paper today and who buys physical gold, the people buying paper are either prevented by charter from buying physical. So if you run a pension fund, you have both regulations, you probably have some sort of government supervisor, looking over your shoulder, telling you what you can and can't do, and you have a charter, and you have a board, any one of which can say you're not allowed to own a physical commodity. So the only vehicle you have available to you is either GLD or futures. The other thing is that futures are just a better vehicle for trading because the spreads are so tight. If you want to buy physical gold coins and then you want to sell them back, you're going to lose a couple of % to the bid-ask spread at the dealer. So it's just a great trading vehicle, and it's a way for institutions to get exposure who otherwise couldn't. But I would have to doubt, given how much has been said in the gold community over how many years about the counterparty risks, leaving aside whether or not it's all a fraud and fractionally reserved or whatever, just the counterparty risks, I would have to seriously doubt that there's very many people that are owning futures and in the belief that they actually own gold, and that's their gold ownership position, like in case, you know, it hits the fan. I would have to think nobody who's holding gold for that reason is holding futures, that would be physical, that message has permeated and saturated the marketplace. Everybody knows that. Like if you went into a Swiss private bank and you went into their conference room where right now somebody from the Middle East is setting up a multi-generational trust, is anybody saying, let's put some gold futures in the trust? Nah. There's gold in every one of those trusts, by the way. 100% of them have gold in it, unless the person is dead set against it. Maybe 2 or 3 or whatever percent. But that gold is going to be bars held in the bank's basement. It isn't going to be, you know, that kind of paper, futures or GLD or whatever. And that's how the world is today.
Keith, it was really great speaking with you, especially the last part here about the manipulation, because I have to be honest with you, I've always been critical of the banks, but it's always good to hear both sides of the argument. And any final words to the viewers?
Yeah, if I could just say one thing, and the point I was making about the spoofing is that every once in a while stories are coming out that banks are doing genuinely, you know, bad things, and the spoofing is obviously the least of it. You know, the statements they're making to the public about how they're doing God's work while they're meanwhile lobbying the government and lobbying the Fed for all kinds of special favors. They're obviously cronies at best, and so it's easy for everybody to hate them because in a lot of ways they are bad actors. I would frame it that they're the product of this crony system. You're going to have all this regulation and you're going to have a central bank. That's what you're going to end up with, is these profiteers on the paper system. And so they're easy to hate, but doesn't mean that every last thing of which they're accused is necessarily accurate. And that would be the kind of the nuance I would put on it. But thanks for having me on the show. This has been fun and a great discussion, and I hope people watching this appreciate it.
Oh, thank you, Keith. Thank you for giving us your time, and hopefully we'll speak again soon.
All right, absolutely.